Mr. Kuldeep Jain, founder and managing director at CleanMax's and Vero Energy, joining us on the show. Mr. Jain, thank you so much for your time and good to be speaking with you. Good to have you in the studio with us. You know, this quarter, at least compared to the base quarter, you've turned profitable once again compared to the base on a year-on-year basis. Talk to us about what are some factors that have worked out for you this time, this quarter, and what's the outlook going ahead?
Three drivers. First is our sales have doubled quarter on quarter, so volume growth. Second is EBITDA margins in both our business segments have increased, so greater profitability. And third is our interest cost also has come down. It used to be 9.4% a year ago, it's 8.4% today. So all these three factors combined creates a very healthy profit after tax growth for us.
And Mr. Jain, how much of this is sustainable in the coming quarters?
I think we certainly are looking at very high continued revenue growth. In fact, we've given a guidance of at least 3,000 crore EBITDA for next financial year, which is FY 27-28. And that's up from about 1,300 crores in FY 26. So from 1,300 to 3,000 in 2 years, that's a huge growth. So, that revenue growth part of the story remains. A lot of the EBITDA margin improvement comes from operating leverage. So as you grow, your costs will not really increase that fast. So operating leverage should also sustain. And, we think we'll have stable to continued decline in interest costs. So, I think all those three drivers should continue for a couple of years.
Okay, let's talk about your capacity. Mr. Jain, you've guided to add about 1.5% gigawatt in FY 27. 1 quarter in, what is this number looking like? And are you on track for this 1.5? Maybe are you looking at exceeding that?
So our guidance was that we will add at least 1,500 megawatt this year. We've done 500 megawatt in the first quarter. So we are on track to meet that guidance. And, we may beat it, but let's see. It's early days yet.
Yes. Let's also talk about data centers and AI, because I was just going through your financials and that contributes about 42% of your contracted portfolio. How is this segment expected to shape up going forward?
So, we are data and AI for us in the past 2 years has grown 10 times. So it used to be about 250 megawatt. It's become 2,500 megawatt in just 2 years. So that's, history is a indicator of future. And every 1 gigawatt of data center requires about 6 gigawatt of renewable power to power only 75% of that load. So, that equation is just huge demand. And we have 35% market share of all hyperscaler business in India, which is the likes of Apple, Meta, Google, Amazon, and we've announced new deals with all of them in this calendar year itself. So, the outlook for that looks very, very rosy and robust. It's been a huge growth driver for us and is expected to continue.
Any number? Can you quantify what percentage of your revenue will be driven by this segment, let's say in the next 3 to 5 years?
So tough to really know because the deals end up being a bit lumpy. It's such a huge demand segment, the deals end up being lumpy. But yes, look, it's grown from 12 to 14% of our business 2 years ago to 42% now. So the trend is unmistakable, but it's wrong to give a guidance without having contracted volumes in hand.
Okay, let's also talk about your total capacity. We did talk about it briefly. Your contracted renewable portfolio, I believe, has now reached 6 gigawatt. What is the trajectory looking like? I believe 1.5 gigawatt is under execution currently. How will it translate into revenues going forward?
So we have a contracted and not built capacity of about 2,600 megawatt. You could argue this is pipeline. And we are adding at least 1,500 megawatt a year. So, you could say that for at least 1.5 years at any point in time, we have enough sales done for the next 1.5 years of new capacity addition. And of course, our business is such that we also sell every day. So, we've added a few hundreds of megawatts in the last quarter itself. So that is also a constant, growth of sales. So looking good on both fronts.
Okay, And also speaking about the fundraising that you have announced, 2,500 crores is what you're looking to raise. A couple of things I want to know here. First, what is the debt on the books looking like on a consolidated level? And secondly, of this fundraise, what would the deployment plan be in terms of a timeline, and where and how is this money going to be deployed?
So just correction, we're doing a bond issue. It's not a fundraise. When you say on an audience, it feels like, oh, you're raising more equity, which is not true. We've already raised the equity we needed in our IPO. But we are doing a bond issue, and we are quite excited to tap the domestic capital markets for the first time. Our credit rating also got upgraded recently to AA minus, and therefore that new pool of debt opens up to you. And we are refinancing some existing project debt and taking on some new borrowing as part of this targeted bond issuance, which our board approved last Friday. And we intend to do that in the next 3-4 months. But it's really to repay some existing debt. And, we always keep needing funds for continued growth.
Understood. So that's as far as fundraising is concerned. But let's also talk about your corporate structure. And recently you amalgamated many of your subsidiaries to improve the corporate structure. What is the strategy here, and how will it benefit the company, the group as a whole?
So we had a lot of rooftop subsidiaries. Right. For the last few years, we've done most of the rooftop projects on the main company balance sheet. But the ones who were there since before that, we are just merging it together to just simplify it and reduce the corporate overheads of managing more subsidiaries. So it's a simple enough thing. It's a 100% owned subsidiary. It's merging into the parent. There's some benefits of unabsorbed depreciation, which helps you from a taxation perspective. There's some cash flow benefit. And overall, it just simplifies the structure and leads to lower cost.
And speaking particularly of the rooftop solar business, there is so much push coming in from the government for this particular segment currently, and there is so much government support. How are you looking to tap into that, and what could the benefits be for your company?
So we sell to commercial and industrial, which is really large corporates. For that segment, rightly so, there are no subsidies by the government because no subsidies are needed for companies to adopt rooftop solar and achieve a cost reduction. And rooftop solar is about 13-14% of our current EBITDA run rate. So it's not a huge part of our business. We are just simplifying some corporate structure relating to that.
And what will the key priorities for the company be in FY27 and FY28? You did share your EBITDA outlook for the next few years, but what are you working on at this point in time in terms of strategy?
So I think one is just growing our capacity to execute. Today we find that we are challenged or we are limited by how much we can add and not how much we can sell. So, we've added in the last 12 months 1,700 megawatt, and a year ago, if you looked at that number, we would be adding 500 megawatt a year. So we've already grown that execution capacity from 500 megawatt to above 1.5 gigawatt a year. So continuing to grow that, which means investments in land and transmission, just building that organizational capability, entering new states in CNI like Andhra Pradesh or Rajasthan and Uttarakhand and so on. So those are one kind of priority. That just improves how fast we can put up these projects. Second priority is, of course, as we grow larger, you need to tap more sources of debt capital, because just relying on either banks or NBFCs and all, you're becoming a much bigger balance sheet. You need to diversify your pool. That's why the tapping of domestic corporate bond market. And third is also partnering for growth. So, we find that the business model we pursue has lots of other players who want to partner with us, lots of multinationals, like in Osaka Gas and so on, where we've had a co-investment relationship so far. Just growing those partnerships opens up new sources of capital for continued growth that is coming our way.
Just very quickly, lastly, I just want to get your sense on where you're seeing the margins go from here. Historically, you're usually around 60. We've seen this number come to 50-51% right now. When are we looking at achieving 60 and crossing that ahead?
The way we look at margins is we have two operating segments. And in this quarter, margins have improved for both our operating segments. So for renewable energy power sales segment, margin has gone from 76% to 84%. So that's an improvement.
Sure.
In renewable energy services segment, margins have gone from 9% to 11%. That's also an improvement. But as the mix changes, if you look at an overall company level, Based on mix change, you can look, but the way to look at it, we report two business segments. They're both very different. In one, we have capital expenditure, we are selling power. So that's a 84% EBITDA margin business. In the other, we are building plants and operating and maintaining for our corporate customers. So that's a lower margin segment. So, depending upon the mix, the overall number may change, but as long as both segments keep growing their margin, that's only positive for us.
Mr. Jain, we are completely out of time, but thank you for taking your time out and joining us, and we look forward to interacting with you more often in our Mumbai studio. But that's all the time we have on this